Welcome to Chapter 10. In Chapter 10, we will focus on taxes inside of brokerage accounts. A bit of a refresher. Brokerage accounts are investment accounts that can be used by just about anyone to transact stocks, bonds, and other assets. If you're at least 18 years old, you can use a brokerage account. So unlike other types of accounts that are connected to your employers, like 401ks, you don't need to have a job, and you don't need to have a certain level of income. And there are no age restrictions about depositing and withdrawing. And that's a really nice benefit. They are the most liquid of all accounts. You can put money into these accounts anytime you want. You can withdraw from them at any point. So they're a great place to put money if you know you might need to withdraw those funds in the near future. However, they don't offer any tax sheltering, and that is a major downside. Before we get into the specifics, I want to introduce a new key term: taxable event. A taxable event is any action or event that could cause you to pay taxes. In other words, it is a necessary but not sufficient condition for being forced to pay taxes. For example, let's say you sell a house. Selling a house is a taxable event. It means the IRS will keep track of this event. It means you may get some sort of document in the mail or via email explaining that you've sold that house and that you might need to pay taxes, but you might also not need to pay taxes. It depends on the specifics of your situation. For example, if you've lived in your house for at least 2 of the last 5 years, in most cases, you're not required to pay taxes. So selling a house is a taxable event that might cause you to pay taxes. The same can be said for profits in a brokerage account. If you have a brokerage account and earn a profit, that is a taxable event. You will get some sort of documentation about that event occurring, but things like your level of income will determine whether you actually are required to pay taxes. When you earn profits inside a brokerage account, they can be taxed as income or a new type of taxes, capital gains taxes. Let's see how old Donnie Dumbass does with a question related to capital gains taxes. As the first time seeing a question like this may seem a little bit tricky, but I'm telling you, as we go through the examples and you have a chance to do some practice problems, it will start to click. Let's say Sandria is single and has an income of $62,000 and capital gains of $20,000. Income can come from various sources, usually from your job, but also from investment earnings. Likewise, capital gains can come from multiple sources, but most likely it comes from profits of stock investments inside a brokerage account. In this case, a very common mistake that people will make, including Donnie Dumbass, is to assume that the 0% capital gains tax rate is applicable here. And I could see why you would make that mistake. If you look at that capital gains tax bracket for 2026, you can see that any capital gains between 0 and $49,450 are taxed at a 0% tax rate. So it seems to make sense that $20,000 in capital gains, which is less than $49,450, would be taxed at 0%. But that is not the case. Now let's see how a true genius would do this question. And this is a little tricky the first time you see it. The fact that Sandria has $62,000 in income not only affects her income taxes, it also determines her capital gains taxes. Since Sandria has $62,000 in income, we will place that as the starting point when solving for capital gains taxes. In other words, her capital gains aren't assessed from $0 to $20,000. They are assessed from $62,000 to $82,000. And that would lead to the 15% tax rate being applied. Let's talk about this a little bit. Perhaps this diagram will make it a little bit more clear. Again, we're talking about Sangria's situation. She has $62,000 in income. And that $62,000 in income will serve as the starting point for determining her capital gains. In other words, when we look at the tax bracket, we will start with the $62,000 value as the bottom value for capital gains. We will then assess $20,000 in capital gains on top of that figure. So the $62,000 to $82,000 range is the capital gains tax range that Sandria will pay. And again, she would be assessed at a 15% rate, leading to $3,000 in capital gains taxes. Let's do another example, and let's do it correctly. Simon is single and has an income of $800,000 and capital gains of $40,000. Let's avoid that common mistake, which is to assume with $40,000 in capital gains, Simon would be in the 0% bracket. That is not the case. Instead, with $800,000 in income, that is the beginning point of our capital gains taxes. So that will put him in the 20% bracket. He will pay $8,000 in capital gains. And I hope an example like this kind of indicates why we solve for capital gains in the process that we do. Simon is very wealthy. He's making $800,000 a year. And the federal government typically likes to tax people who are making a lot of money. So even though he has $40,000 in capital gains, which is a relatively small amount relative to his income, he's still very wealthy and they want to tax all of his economic activity. So with $40,000 in capital gains, he falls into the highest tax bracket as a high earner. He pays a 20% tax rate. One more example here. Lucy is single and has an income of $9,000 and capital gains of $40,000. Now, even though she earns the same capital gains as Simon did in the previous question, you can see that her combined income and capital gains is $49,000. All right, so thinking about the capital gains tax bracket there, she has $9,000 in income. That's our starting point. If we add $40,000 in capital gains on top of that, that is only $49,000 in combined income and capital gains. That means that $40,000 she earns is in the 0% tax rate. Remember earlier when we learned about taxable events? You can see here why earning profit in a brokerage account via capital gains triggers a taxable event, but not necessarily taxes. For college students who typically have low income, capital gains are usually assessed in that favorable 0% tax rate, which means you don't have to pay any taxes at all if your income and capital gains are low enough. Let's now look at the specific rules. For those who hold stock inside a brokerage account, there are two ways you can realize a profit. One is by earning a dividend, and another is by selling stocks at a profit. The rules that apply for taxes are different between dividends and selling stock at a profit. Specifically, if you earn a dividend, that dividend could be taxed as capital gains or income, and the determination is how long you've held that stock when the dividend is earned. If you've held the stock for more than 60 days when you earn a dividend, that is called a qualified dividend, and it is taxed as capital gains. If you've held a stock for 60 days or less when the dividend is earned, it is taxed as income. Now, if you refer back to the tax brackets for income and capital gains, you will see that the capital gains tax brackets are more favorable. They are lower tax rates. So you would prefer to pay capital gains taxes instead of income taxes. So long-term investors are rewarded by the federal government. If you're not making a lot of transactions and you're holding stock for a long period of time, most of your dividends will be qualified and taxed at the more favorable capital gains tax rate. Selling stock inside a brokerage account also triggers a taxable event. And again, it's the duration that you've held a stock that will determine how it is taxed. When you sell stock for a profit, if you've held that stock for more than 1 year, the profits will be taxed as capital gains. If you've instead held that stock for 1 year or less, the profits will be taxed as income. So, if at all possible, you would prefer to hold your stock for at least 1 year before selling it. Let's take a look at a thorough example here. A married couple earns $120,000 in combined salaries. In a brokerage account, they sell stock for $16,000 that they bought 11 months earlier for $12,000. They also earn $3,000 in qualified dividends. Okay, so we need to go through each of these and figure out how it should be classified. Let's start with income taxes. Now they've got income of $120,000 from their salaries, and that is almost always the starting point. But we will be adding content to this. $120,000 in income is not their total income, that's just their total salaries. In this specific question, we also need to add the profit from their stock sale. They bought the stock for $12,000. They sell it for $16,000 after 11 months, and that means there is $4,000 in profit that needs to be taxed. Please note there that you are taxing the profit off the stock sale, not the total revenues from the stock sale. All right. So again, you've paid $12,000 for the stock. You sell it for $16,000. That's a $4,000 profit, and that is what is taxable. So in total, this married couple has $124,000 in income. And if we run that through the bracket that you see over there on the right, that would lead to $16,704 in income taxes. At least that's what we've solved for so far in this class. Eventually, we'll learn about tax deductions and tax credits, and that will make all of this more complicated. What about the capital gains taxes? In this question, this married couple has $3,000 in qualified dividends, and that is capital gains. So we start with $124,000 in income. They've earned $3,000 in capital gains, and both of these figures are needed to figure out what their capital gains tax rate is. With an income of $124,000, you can see that they are in the 15% bracket for capital gains taxes. So they will pay $450 in capital gains taxes. What about those two other forms of taxes that are mandatory to pay? Social Security and Medicare taxes. Well, I've got good news for you. Investment earnings in a brokerage account or outside of a brokerage account are never subject to Social Security or Medicare taxes. So for this specific question, the married couple has $120,000 in combined salaries, and that is what is actually taxed by Social Security. Likewise, for Medicare taxes, the investment earnings, irrelevant. The only thing that's taxed is employment income. And that is definitely good news. Now let's talk a little bit about timing. When do you actually pay the taxes? Well, when it comes to employment earnings, typically you're paying as you go, at least for the most part. So for example, I get paid once per month, and when I receive my paycheck, all taxes, federal, state, Social Security, and Medicare taxes, all of those taxes have already been estimated by my HR department and paid. So when I receive my paycheck, a significant amount of money has already been taken out and allocated to taxes. Now when I file at the beginning of the next year for this current year, I will need to make some adjustments because I probably overpaid or underpaid a bit. But the bottom line is most of my taxes have been paid during the year. However, on investment earnings, you pay the taxes when you file. You don't pay as you earn, you pay when you file. So if you've earned a bunch of money via investment earnings during the year, you better have funds ready to go. It is quite common for people who are new to the investment game to not realize that they have to pay taxes, and so when they go to file their taxes the following year, they find out that they owe thousands of dollars and they don't have the funds available. So make sure you're prepared and organized. Let's summarize what we've learned in this chapter. Investment earnings in brokerage accounts are taxable events. Taxable events are necessary but not sufficient conditions for being forced to pay taxes. So if you earn money in a brokerage account, you realize those gains, that could lead to taxes, but it depends on your income level and other specific characteristics. Realized profits on stock earnings can be taxed as either income or capital gains, and that is dependent on how long you've held the stock when those profits are realized. Generally speaking, the federal government rewards people who are long-term investors. But you need to know the specific rules. You need to know the cutoff points. When you earn money via a dividend in a brokerage account, the cutoff point is 60 days. If you've held the stock longer than 60 days when that dividend is earned, it's a qualified dividend and it's taxed as capital gains. If 60 days or less, it's ordinary income. As far as selling stock at a profit, the cutoff point there is 1 year. Again, you need to know those rules. Those rules have been around for a very long time and they are unlikely to change anytime soon. Investment earnings are paid at filing, not as you earn. So as we just mentioned, when you receive profits in a brokerage account, make sure you recognize that those are not taxed, but will be taxable when you file for the following or in the following year for the current year. And finally, what about bonds? I haven't talked about bonds really at all up to this point, and there's a couple reasons why. One, bonds are more complicated, and the way bonds are taxed depends on the specific type of bond that you own. So I think it's just kind of a waste of time for me to go through all the details when they are easily found online. Secondly, it's often recommended that you hold your bonds in tax shelters like IRAs, 401ks, and the like. And if you're holding bonds in those accounts, there's no taxes to worry about until withdrawal anyway. Hope you enjoyed the chapter. On to the next one.